Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today I'm going to talk about 10 financial planning and tax strategies to continue to prepare for in 2022. It's hard to believe we are almost halfway through May of 2022. So if you haven't already done so, now is a good time to create a financial plan to help meet your financial goals for the remaining of the year and going forward. To help you with your planning, here are 10 simple financial planning and tax saving strategies to consider for the remainder of 2022. The first is maximize your health savings account, your HSA contributions. For 2022, you can contribute up to $3,650 for individual coverage and up to $7,300 for family coverage into an HSA. And remember that HSA is not a use it or lose it benefit like your flex spending account. If you do not need to withdraw from your HSA for current medical expenses, you can allow the account to accumulate and grow tax deferred. You may consider investing the money to provide it a chance to grow until even your retirement. So here's a quick tip here. A great way to generate tax-free income in early retirement is to withdraw from the HSA for prior year medical expenses. So you want to make sure you keep really good detailed records here. The second area is to optimize your 401k plan. I know I've said this over and over, but here's a hint, and most people haven't done this. For the first time since 2018, the IRS actually finally increased the 401k and 403b contribution limits. You can contribute up to $20,500 for 2022. This is up from $19,500. The catch-up contribution for participants age 50 and older still remains unchanged at $6,500. But this gives you the opportunity, if you're 50 and older, that you can actually max out your 401k at $27,000 of pre-tax contributions. If cash flow does not allow you to maximize the contribution, at least consider increasing your contribution rate another 1 to 2% for the remainder of the year. If you've not rebalanced your portfolio over the past year, it has likely drifted away from its target allocation. Now is the time to consider rebalancing back to target so your portfolio is not taking on more or less risk than you're willing to take. Now, be careful here. We're in a really volatile market, as many of you may know, and this does not mean you shouldn't rebalance. If you haven't rebalanced over the last 3 to 4 years, even with the market correction right now, you're probably not allocated properly. So you really want to look at not only your allocation, but has your risk tolerance changed over the last 3 to 5 years? Meaning you're 3 to 5 years older, 3 to 5 years closer to retirement. As we get closer to retirement, we want to take less chance of current market volatility. So we want to make sure that you're looking at not only your allocation, but your risk tolerance. So here's how to kind of look at your risk tolerance. If you've been really happy up until December 31st, 2021, of all the market increases, you might think you have a very high risk tolerance. You really get to take a note of your real risk tolerance when we're in the volatility of the market now. So if you're worried every single day because the market's going up and down several hundred points, you're probably invested more riskier than you should be. So if you can't sleep at night, there's an indication that you may be too highly riskily invested. So you want to look at your risk tolerance, even in the volatile markets, rebalance. I'm not saying sell out of your portfolio into cash necessarily. I'm saying you always want to look at rebalancing, making sure your current investments match your current risk tolerance. Number 3 is develop a tax payment strategy. If you are paying federal estimated taxes in 2022, you really want to monitor your tax payments. This will help ensure that you exceed 90% of your 2022 estimated liability, or 100%, in some cases 110% for certain taxpayers, of your 2021 tax liability to avoid underpayment penalties. Remember, estimated tax payments are due quarterly, but it's not the same as a calendar quarter. So those dates, just as a reminder, the first one's already passed. It was April 18th of this year. The next one is June 15th. The one after that is September 15th. And then the fourth quarter payment is due by January 16th of 2023. So if you are someone who pays quarterly taxes, you might just want to put a tickler on your calendar a week or two ahead of time to remind you that these payments are due. Number 4 is fund charitable giving in 2022 with appreciated stock. If you make charitable contributions anyway, consider gifting highly appreciated stock in lieu of cash. A gift of appreciated stock is an itemized tax deduction on your return, and the charitable organization will not have to pay tax on the capital gain. You can then repurchase the stock if it's a stock you want to hold with the cash you would have otherwise donated as an effective way to raise your cost basis in your own portfolio. This is a very effective strategy if you plan it out properly. Again, especially if you're already giving charitable contributions of cash, there may be a more efficient way to do that. Number 5 is protect your wealth. We talk about this all the time when we work with our clients. If it was just about the numbers, my job would be really easy. But part of increasing your wealth and increasing your financial well-being is that you have more to protect. So one of the ways you can do this against unforeseen circumstances is with an umbrella insurance policy. So an umbrella insurance protects against liability claims above and beyond the amount covered by your automobile and homeowners coverage. Depending on your coverage, umbrella policies are relatively inexpensive and provide an amazing source of peace of mind. And take it from me, who was in an accident, who I was not at fault, but it was an accident. These things happen. If I were in the reverse situation and I didn't have an umbrella policy, then everything I've accumulated would be at risk. So if you own a home, if you have 401k plans, if you have wealth, if you have things of value, people seek those kinds of situations, and you want to make sure that you're protected. I will tell you, probably no less than 80% of the people that I meet with, when we look at their property and casualty insurances, right, one of the risk management areas that we deal with, about 80% are underinsured given their wealth. So things to look at: if you're a parent and you're driving other kids around, that's an area because you're at risk. If you own a home with this great amount of appreciation, is your home protected properly? And then with vehicles, many of my clients have purchased Teslas and things of greater value. Are they protected the way that they need to be if there was simply an accident? So you want to make sure you're looking at not only your insurances on yourself, so your life, health, disability, long-term care. You also want to make sure that the items that you have of value, as those appreciate, that you also look at having a review of your property and casualty insurances. The next area is huge for me when I'm working with clients is executing an estate plan. Estate planning is by far the most forgotten area of financial planning, and this is regardless of wealth. There are many examples of famous wealthy people who have died intestate without even a simple will. Most people think because you have a tremendous amount of wealth that you know how to manage it. There's a difference between being able to generate revenue, generate income, and actually creating and protecting your wealth. So if you've died without a will, this is actually called dying intestate. And as a result, you actually won't end up providing your loved ones probably what you would want them to have, because the state decides based on state laws how your estate will be divided amongst your heirs. You can prevent this by having documents drafted that reflect your wishes. But just remember, a simple will on its own still requires your estate to go through probate. This is actually a really expensive and time-consuming process for your beneficiaries. And most of them are also dealing with the loss of you. So having them go through this process is very, very stressful. I've seen many families have a terrible time going through the process because everyone thinks they know how the person who's passed wanted their estate to be distributed, and there's usually differences of opinion there. Most people I work with need a more comprehensive living trust. This takes care of many of your estate planning issues and allows you to decide how you want your estate distributed. In addition, a living trust helps you avoid probate and is private, where probate is a public event. So while you're doing estate planning as well, you can also integrate charitable giving as a part of your overall estate plan. Number 7 is give with a warm and generous hand. If you are fortunate enough to have surplus wealth, consider making financial gifts to loved ones while you're still here. For 2022, you may gift $16,000 per person to as many people as you like without being subject to gift tax and IRS filings. This reduces the value of your estate while providing an immediate benefit to others. And then you might actually get to enjoy them enjoying the gift as well. Number 8, if you miss the boat on refinancing your mortgage because interest rates have gone up dramatically, you should still consider a HELOC or home equity line of credit. This is something you want to consider before you actually need it. Like your mortgage, you have to qualify for a HELOC. But if you have it in place before a financial emergency exists, then you can tap into it for short-term and long-term needs. Even if you have substantial equity in your home, if you lose your job, for instance, you would not qualify for a HELOC and would not have access to your own equity. Number 9, protect your credit. Okay, this is huge, especially in our cybersecurity age. You may want to consider implementing a credit freeze with the 3 major credit bureaus, Equifax, Experian, and TransUnion. This can prevent fraudulent credit from being established through any of these agencies. A credit freeze is free and fairly easy to do. Now, you'll have to jump through some extra hoops when you need to have new credit or loans put in place, but it's much easier. This is a much easier process than unwinding credit fraud. Last, and this is something that I put in here last minute because I did it for myself, is search for unclaimed property. Consider performing a search for unclaimed property in your resident state and any state in which you've previously lived. Approximately 1 in 10 people have some kind of unclaimed property, and you can do a search for your state at unclaimed.org. I tried this a few years ago out of curiosity and found that I also had unclaimed property. This was not real property, but because I had moved a few times, I had a handful of commission checks that were never received and deposited into my account. This is less likely now that most of my fee and payments are deposited automatically, but I had a few $1,000s that I was able to submit a short form for and have resent to me. This was way better than checking your couch for loose change. So I hope this was helpful for you today. For more financial planning tips for the remainder of 2022, please take advantage of our complimentary discovery session. As a CFP, I work with you to look at the big picture to ensure everything is working together and ensure any gaps can be taken care of before an issue actually takes place. Thanks, everybody. I'll see you next week on Friday's Focus on Finances.